Life insurance is one of the most important components of any individual's financial plan. However, there is a lot of misunderstanding about life insurance, mainly due to the way life insurance products have been sold over the years in India. We have discussed some common mistakes insurance buyers should avoid when buying insurance policies. 1. Underestimating insurance requirement. Many life insurance buyers choose their insurance covers or sum assured based on the plans their agents want to sell and how much premium they can afford. This is a wrong approach. Your insurance requirement is a function of your financial situation and has nothing to do with what products are available. Many insurance buyers use thumb rules like 10 times annual income for cover. Some financial advisors say that a cover of 10 times your annual income is adequate because it gives your family 10 years worth of income when you are gone. But this is not always correct. Suppose you have 20-year mortgage or home loan. How will your family pay the monies after 10 years, when most of the loan is still outstanding? Suppose you have very young children. Your family will run out of income when your children need it the most, e.g. for their higher education. Insurance buyers need to consider several factors in deciding how much insurance cover is adequate for them. Repayment of the entire outstanding debt, e.g. home loan, car loan, etc. of the policyholder after debt repayment. The cover sum assured should have surplus funds to generate enough monthly income to cover all the living expenses of the dependents of the policyholder, factoring in inflation after debt repayment and generating monthly income. The sum assured should also be adequate to meet future obligations of the policyholder, like children's education, marriage, etc. 2. Choosing the cheapest policy. Many insurance buyers like to buy policies that are cheaper. This is another serious mistake. A cheap policy is no good if the insurance company for some reason or another cannot fulfill the claim in the event of an untimely death. Even if the insurer fulfills the claim, if it takes a very long time to fulfill the claim, it is certainly not a desirable situation for family of the insured to be in. You should look at metrics like claims settlement ratio and duration-wise settlement of death claims of different life insurance companies, to select an insurer that will honor its obligation in fulfilling your claim in a timely manner, should such an unfortunate situation arise. Data on these metrics for all the insurance companies in India is available in the IRDA annual report on the IRDA website. You should also check claim settlement reviews online and only then choose a company that has a good track record of settling claims. 3. Treating life insurance as an investment and buying the wrong plan. The common misconception about life insurance is that it is also as a good investment or retirement planning solution. This misconception is largely due to some insurance agents who like to sell expensive policies to earn high commissions. If you compare returns from life insurance to other investment options, it simply does not make sense as an investment. If you are a young investor with a long time horizon, equity is the best wealth creation instrument. Over a 20-year time horizon, investment in equity funds through SIP will result in a corpus that is at least 3 or 4 times the maturity amount of life insurance plan with a 20-year term. With the same investment, life insurance should always be seen as protection for your family in the event of an untimely death. Investment should be a completely separate consideration. Even though insurance companies sell unit-linked insurance plans, ULIPs, as attractive investment products, for your own evaluation you should separate the insurance component and investment component and pay careful attention to what portion of your premium actually gets allocated to investments. In the early years of a ULIP policy, only a small amount goes to buying units. A good financial planner will always advise you to buy a term insurance plan. The term plan is the purest form of insurance and is a straightforward protection policy. The premium of term insurance plans is much less than other types of insurance plans, and it leaves the policyholders with a much larger investable surplus that they can invest in investment products like mutual funds that give much higher returns in the long term, compared to endowment or money-back plans. If you are a term insurance policyholder, under some specific situations, you may opt for other types of insurance, e.g. ULIP, endowment or money-back plans in addition to your term policy, for your specific financial needs. 4. Buying insurance for the purpose of tax planning. For many years agents have inveigled their clients into buying insurance plans to save tax under Section 80C of the Income Tax Act. Investors should realize that insurance is probably the worst tax-saving investment. Return from insurance plans is in the range of 5–6%, whereas Public Provident Fund, another 80C investment, gives close to 9% risk-free and tax-free returns. Equity-linked saving schemes, another 80C investment, gives much higher tax-free returns over the long term. Further, returns from insurance plans may not be entirely tax-free. If the premiums exceed 20% of sum assured, then to that extent the maturity proceeds are taxable. As discussed earlier, the most important thing to know about life insurance is that objective is to provide life cover, not to generate the best investment return. 5. Surrendering life insurance policy or withdrawing from it before maturity. This is a serious mistake and compromises the financial security of your family in the event of an unfortunate incident. Life insurance should not be touched until the unfortunate death of the insured occurs. Some policyholders surrender their policy to meet an urgent financial need, with the hope of buying a new policy when their financial situation improves. Such policyholders need to remember two things. First, mortality is not in anyone's control. That is why we buy life insurance in the first place. Second, life insurance gets very expensive as the insurance buyer gets older. Your financial plan should provide for contingency funds to meet any unexpected urgent expense or provide liquidity for a period of time in the event of a financial distress. 6. Insurance is a one-time exercise. I am reminded of an old motorcycle advertisement on television, which had the punchline, "Fill it, shut it, forget it." Some insurance buyers have the same philosophy towards life insurance. Once they buy adequate cover in a good life insurance plan from a reputed company, they assume that their life insurance needs are taken care of forever. This is a mistake. Financial situation of insurance buyers change with time. Compare your current income with your income 10 years back. Hasn't your income grown several times? Your lifestyle would also have improved significantly. If you bought a life insurance plan 10 years ago based on your income back then, the sum assured will not be enough to meet your family's current lifestyle and needs, in the unfortunate event of your untimely death. Therefore, you should buy an additional term plan to cover that risk. Life insurance needs have to be re-evaluated at a regular frequency, and any additional sum assured, if required, should be bought. Conclusion: investors should avoid these common mistakes when buying insurance policies. Life insurance is one of the most important components of any individual's financial plan. Therefore, thoughtful consideration must be devoted to life insurance. Insurance buyers should exercise prudence against questionable selling practiced in the life insurance industry. It is always beneficial to engage a financial planner who looks at your entire portfolio of investments and insurance on a holistic basis. so that you can take the best decision with regards to both life insurance and investments.